Flybe is Europe's largest independent regional and UK's leading domestic low-cost airline, with 55% of domestic market outside London. It also has a franchise partner in Scotland and operates a joint venture with Finnair, which also flies planes for other airlines under contract and provides aircraft maintenance and training. Some of Flybe's competitors are Ryanair, EasyJet, Wizz Air and Jet2. This group of low-cost carriers work around the concept of no frills. In analysing the industry using Pastel, a key political factor affecting the industry is air passenger duty, which currently stands at £13 per passenger for all UK departure flights for a travel distance of up to 2,000 miles, which represents 160% rise over the past 5 years. For a domestic airline as Flybe, it particularly has a massive impact as a passenger has to pay air passenger duty twice on a return flight at a very high rate compared to non-UK departure flights. Overseas leisure trips by UK residents reduced from 60 million in 2008 to 49 million in 2012, a fall of 11 million or 21%. There are few economical factors affecting the industry. Difficult economic situation has affected the individual income. Demand for air travel is by and large dependent on the income of the individual. Eurozone crisis has also clearly affected low-cost short-haul air travel industry. One key economical factor affects the industry is volatile fuel pricing. Fuel prices have a profound effect on the air travel industry. Much of an airline's pricing and cost structure is based on fuel being available at a certain price. At average, fuel cost is 30% of total expenditures of an airline. If the price changes, airlines must make drastic adjustments. However, the key factors for success will be for the airlines to continue to focus on their strategic positions, better management of their operating expenses, high operation efficiency, high aircraft utilization, and better cost management. High core services standards such as safety and reliability is also a key factor. Examining the industry attractiveness by using Porter's 5 forces, it can be said that it is a highly competitive industry with highly competitive low fare market. Policy of building low fares and low frills together is a competitive advantage. However, the air travel market faced a reduction in market share due to the availability of low-cost coaches, high-speed rails, and ever-increasing sea travel network, which highlights the increasing threats of substitute. Also, high price sensitivity, technology development, and customer loyalty factor has increased the customer bargaining power. Limited choices of suppliers who are not concerned about small airlines and hard to imitate factors give high bargaining power to suppliers. But the level of threat of new entrants is quite low due to high capital investment and high operational cost in a highly politicized industry. This highlights the attractiveness of the industry. With 55% domestic market outside London and overall more than 5 million UK passengers, Flybe is a leading domestic airline. Despite the strong domestic presence, tough economic conditions had hit hard Flybe over the past few years. As substantial increases in jet fuel prices in 2009 and 2011 left many airline industry executives scratching their heads, Flybe also felt the impact of the situation massively. Also, lack of innovative operational strategy, low productivity, and high operational costs were the main factors behind the black hole in Flybe's balance sheet. Evidently, this situation forced the Flybe to issue unexpected profit warnings in 2011-12 financial year, which resulted 36% decline in share prices. And finally, in 2012-13 financial year, Flybe ended up with 21.5 million operating loss and 41.8 million total losses after including restructuring cost. In this situation, Flybe strongly felt that it needed to start some restructuring process, which is already underway now. New top management with more relevant experience is in place with clear goals to turn around Flybe, dubbed as fit to compete, which resulted in loss of almost 25% workforce and runway slots at Gatwick Airport. Under this shake-up plan, the clear goal is to focus on core UK domestic market from regional airports. With new management in place and restructuring plan phase 1 already completed, Flybe already showing some positive signs with almost 13.8 million profits before tax in first 6 months of current financial year. However, there is still a long way to go. This positive sign gave some much needed confidence to investors, resulting in almost 50% increase in share prices from 65p on 4th November to 95p on 28th November 2013. As we look at the financial ratios of Flybe, it shows that total debt ratio to total equity is very high. However, as turnaround plan is in place, total debt has fallen from 120 million in March 2013 to 98 million at the end of September 2013. When we do the SWOT analysis of Flybe, there are few clear and significant strengths, i.e., strong regional presence with established network and established market share, which can be a strong base for future opportunities, i.e., further regional growth and possibility of new regional joint venture once the core business is fit to compete. However, lack of presence in financial hub and most populous city of the country and low productivity are serious weaknesses. Also, these weaknesses leave Flybe exposed to threats more than its competitors. Considering our analysis, Flybe now has the right mix of operational procedures to run a successful, profitable airline through its strategic positioning of leadership in regional presence. To enhance its profitability, Flybe should not change its strategic position. Future challenges for Flybe will be to achieve financial stability by developing further in sustainable regional business model, achieve industry average productivity, and finally deliver industry average return on investment. After careful analysis of all the available data, we recommend that Flybe should focus on the basics: higher utilization, lower fares, a more judicious selection of routes with the stress on the less popular regional routes where the major low-cost carriers don't compete. Develop European routes from Southampton, Birmingham, Manchester and Belfast to target leisure travelers who book early, providing valuable cash and making earnings more predictable. The rapid and profitable growth of leisure airline Jet2.com has shown there is a demand for this kind of service. Some critics say that by just focusing on regional routes, Flybe is ignoring London, but we believe that Flybe's strategic position with strong rail and road links to Southampton Airport provide great opportunity for Flybe to attract a lot of London-based passengers if it can provide competitive fares and facilities. After our analysis, we can say that change of management and restructuring plan, which is being executed perfectly and had turned around overall business into profit for first 6 months of this financial year, Flybe is in much stable position compared to last financial year. On this space, we recommend that Flybe is an investable company as long as they vigorously keep following the restructuring plan and the recommendations we made in this presentation. Relatively low share prices, which almost doubled over the last few months, is a positive sign, but it must be said that Flybe still has a long way to go.